Did you know that you can rent your house tax-free? Yes, well, there's actually some tax code that allows you to do that, but like with anything else, it's more complicated than just that. If you're a real estate investor, you might have heard of this rule. It's called the Augusta Rule. And basically what it is it allows you to rent your house out, your residence out, for up to 14 days tax-free. You don't have to report the income as taxable income. The flip side is you don't get to deduct any of the rental expenses, but that's okay because you're not reporting any income. So let's dive into this Augusta Rule. In the tax code, the IRS states that you can rent your house for less than 15 days, your residence for less than 15 days, and if you do that, you don't have to report that rental income as income. Now, what is your residence? Well, we'll talk about that later, but just know that it has, an easy qualifier is your primary residence, since that is a home that you live in, right? And we'll talk about second homes, third homes, vacation homes, all that down the road. But for now, just know that you can rent your residence out for up to 14 days without reporting any income tax. And that could, open up some strategies here for tax planning if you haven't already thought about that. Now, when the IRS says you can't deduct rental expenses, it really means that, because rental expenses are meant to offset rental income. So rental income and expenses are usually reported on the Schedule E of the tax return. And if you have a primary residence, you usually report your mortgage interest deduction and your real estate tax deduction on the Schedule A. Those deductions are not affected by this rule. You would still report those things on the Schedule A if it's your primary residence. The IRS is just talking about not allowing you to deduct things like, insurance expense or HOA fees, those kinds of things that you would normally deduct against rental income. They're not allowing it in this case because you don't have rental income. Now, let's take your primary home, for example, the home that you live in, the home that you bought. Maybe it's your first house, doesn't matter. It's the home that you currently live in, and it's your primary residence. This qualifies for this rule, all right? And that's because you just live in the home. You call it your residence. The IRS would consider this your residence. You can do this if you want to make a little extra money. Maybe you're going on vacation for a week and you want to put it up on Airbnb for the week and see if anybody rents it out. Well, if you only rent it out for 7 days that year and you made some money on Airbnb, you don't actually have to report that money as income. Or if you have a really nice house, you can rent it out for events and all that, but we'll talk about that later as well. Right now, I want to talk about second homes, vacation homes. Do those qualify for this rule? Well, second homes, in order to qualify as a residence, you have to have stayed in it for at least 14 days out of the year. So if you use the home for at least 14 days out of the year, you can technically call this house a second residence, and then you can then rent it out for up to 14 days of the year for no reported income. That means if you have a nice lake house or something, and you go there every once in a while for a vacation, and sometimes you might want to just Airbnb it out a little bit, not too much, but just a little bit to make some extra cash. This is a good way to do it. I mean, if you Airbnb this home out for the entire year, or you have it listed up as a normal vacation rental, you're still making extra cash, right? That's good. You're making extra cash, but now you have to report the income and expenses on the tax return. And that kind of complicates your tax filing a little bit. In the end, ideally, you're still coming out on top by making this extra money. So something to consider, don't restrict your rental activity just to save on taxes, because renting out your home, your second home, could actually be making you money. So don't let the taxes scare you away from renting out your home for more than 14 days. All right, so what kind of rental can you do with this kind of rule, with this Augusta Rule? Can you do a short-term rental, long-term rental, event rental? What kind of rentals can you do? Well, obviously, it's not gonna be a long-term rental because you can only rent it out for up to 14 days tax-free. If you do a long-term rental, then the entire term of the rental is taxable. You don't get to exclude 14 days, as taxable, but the entire term of the rental is taxable. But these kinds of houses, these kinds of rentals are usually good for like short-term rentals, Airbnbs for weekends, or for the week that you're out on vacation, you want to rent out your house for extra cash. something like that. Or another good thing to do is, corporate events, or even wedding events, any kind of events. Let's say you have a really nice house, maybe it's on the lake, and it's a really nice scenic view, and it's a great place for events, for weddings, for corporate events. Then you can technically rent out this house for those events, and each day of the rental would just count as the day, even if you rent it out for like a few hours that day. So it doesn't have to be, full day. It can be like a really short term, a few hours per day for events and stuff. That also qualifies under this rule. And if you have a business, you can rent out your own property, your own house, to your business for corporate events as well. Now, hint, hint, this is some tax planning here, because your business will get the tax deduction of the rental fees that you pay to yourself, and you, as the owner of the house, don't get to report it as income. So that's like a little double win there, right? Now, make sure it's legitimate. Don't just start writing off rental expenses that you don't have. You really want to make sure it's legitimate. Make sure there's rental contracts in place. Make sure that your rental rates are fair market rates. You don't get to just inflate your rental prices, to charge your business, just to give your business a larger deduction. We want to make sure this passes audit. So the fair thing to do and the right thing to do is to make sure you're charging your business a fair rental market price, and also to make sure there's rental contracts and rental agreements in place, so that if the IRS ever questions it, you have that agreement. And make sure there's actually a transfer of money as well. Like, hey, you paid this much for this day of the rent. There's that rental money transfer. There's a rental agreement. Here are some market price studies. Those are all things that would help you with your case against an audit if it ever gets there. Let me know in the comments what you think about this Augusta Rule. Have you used it before? Have you heard of it? Some people call it a tax loophole. It's not a loophole because it's built into the tax code. So let me know what you think. If you're new here, please subscribe to my channel. That's all I got for now. Take care. I'll see you next time, and stay safe.